Hi everyone, you're all very welcome to our weekend markets roundup for what has been another very volatile and turbulent week in the financial markets. So of course this week, as our videos suggested on Monday, Tuesday and Wednesday and the early parts of this week, we talked about the volatility that was going to ensue this week because we had a range of central banks reporting. We had a number of different economic data prints coming out right through the week up until yesterday's obviously weekly close. So really that's kind of the end of what we would say the major economically fundamental data for the rest of the year. Now, of course, markets are still open next week. Trading will be still available for those who opt to do so. But a lot of the, I suppose, the data, a lot of the fundamental aspects to the markets has been confirmed. And it's really now kind of setting out the tone for the rest of the year to see the trends that was witnessed last week. How does the price action develop? How does the price action reconcile? And of course, waiting for the last, I suppose, week and a half of the year. And then, of course, getting ready for 2023 accordingly. So first things first really is this morning as we look at the markets. I suppose let's take it back to last Tuesday, right? Last Tuesday is probably the best I suppose consideration because of course when we look at last Tuesday, what happened last Tuesday? We had that very volatile CPI data. What happened initially? Indices rallied, right? That less than expected CPI, indices rallied, the dollar weakened, right? So Tuesday, very positive movements for the stock markets. We were continuing to churn higher. However, those moves lasted for all of about 2 or 3 hours as the markets completely undone the initial impulse and actually closed or was traded very low in comparison to where the impulse started from. So if you look at, let's say, 1:30 p.m., 2 o'clock on Tuesday when the data was rallying to, let's say, 5-6 o'clock in the evening as the markets kind of were tilting off for the close, you would actually see that the indices were trading beneath. So that was obviously a clear liquidity hunt. That was the clear stop lossing order block liquidity areas which were rejected after what's been 2 months of very pure bullish price action for the stock markets. And that was really setting the tone for, I suppose, the back foot of bearish price action into the FOMC Wednesday. And of course, Swiss National Bank on Thursday, Bank of England on Thursday, and of course, the ECB on Thursday. So, of course, when we look at the dollar, we had that massive decline on Tuesday. We had that pause and the price actions rallied all the way back up. So that DXY sell-off that we saw Tuesday afternoon has all but been mitigated as the price action on Friday into the close has returned back up into this order block level. And really now it's just a case of, well, given that we have these lower lows, lower highs, it's really just a case of how does the price action react in this negative flagging price action structure. That's effectively in a nutshell. Now, will we see the DXY continue to rally and ultimately try and take out these highs, which would then assimilate probably more risk aversion in those other risk assets, the likes of some of the FX pairs, and of course the indices as well as a prime example of that. And that's really going to be the key consideration this week to see what happens following that kind of down up move. Do we get that kind of rollover again? Do we get a kind of a sort of a relief rally in the indices of what's been a very bearish Wednesday, Thursday, and Friday into the market close? And we'll talk about the indices in a second. Now, as we factor that into the price action, you will see yourself how volatile the price action has been, both from a higher time frame, but also from a lower time frame perspective. Now, when I look at Euro USD, you would see structurally speaking, we did obviously mitigate this June high on euro dollar, which is coming in just above that 105.50, 106 level. We did pop higher, all the way higher into this 107 level, which has been rejected on Wednesday and Thursday. And of course, that was the catalyst for the price action to really reject this level here, as I said, around 107.50, 107, and has ultimately pushed back into this level here. Now, structurally speaking, from a higher time frame perspective, let me just clean up this chart for a moment. We're still seeing bullish order flow, right? That is fundamentally on euro dollar. Yes, the DXY is creating lower lows, lower highs. We have seen that shift in sentiment on the short-term perspective. Excuse me. But from a higher time frame perspective, we're really looking to see, can the price action now start taking out this bullish order flow? And that's the next key consideration, right, on the daily perspective. If you look at it on a 4-hour perspective, you will see that kind of top initially coming in because we had that peak top, then we had that rally, stop hunts, liquidity, 107 rejected, and since then the markets has really kind of churned lower. So really, this area here now between 105, 105.50 is important to see. Does the sell-off continue? And if it continues, are we seeing that paradigm shift in sentiment from what's been a very bullish couple of months for euro dollar and the FX space broadly against the dollar against a shift into maybe profit taking into year end, and I suppose that shift in cycle as well. So that's going to be the big kind of deliberation and consideration for the rest of the year. All right. Now cable as well, structurally similar, very, very similar, right? Now just kind of looking at cable from a brief perspective, let's just tidy up these charts for a second. We can again see similar scenario, right? So we've got a daily order block up here around 125. We did get to highs, short-term highs around 124.50 on Thursday, on Wednesday, before price action obviously rolled over on Thursday and Friday back to this kind of short-term level here at 121, 122. So again, similar to that, very, very deep, sharp selling correction into a very, very deep upside correctional movement. And again, like here on this, you're still seeing bullish order flow. We're still seeing higher highs, higher lows, higher highs, higher lows, higher highs, and we're now coming back to this equal low area. Now, I suppose from a 4-hour perspective, when we look at the price action, we're seeing the cable obviously get that kind of next impulse higher. We've seen that little bit of a top formation, and we've rallied all the way down into this low here, as I said, between kind of 121 and 121.50. So that's really going to be the interesting level this week to see, because we've gone from higher highs, higher lows. If we see 121, 121.50 being taken out this week, of course, that's a break of structure. And then, of course, when we get the break of structure, you're relying on price action, getting that kind of shift, as I said, that shift in sentiment, directional bias, and then seeing does that play out. So, of course, with that then alone, you're looking for a break of structure on cable, but you're also looking to see how does the DXY perform? Does the DXY get that crucial and tangible break that's needed? And then if so, well, then you're starting to look at, right, dollar's broken higher. We've broken through the bearish impulses that's been created over the last number of weeks, and then we're starting to see that shift. And it's really kind of looking at the sentiment and the correlation of the assets to really determine, and then you're factoring that back in really to the price action. You're looking at your trend analysis, whether it's higher time frame or lower time frame. You're looking for the breaks of structure. You're looking for the mitigation of order blocks, the liquidity areas, and that kind of puts some, I suppose, logical, common sense approach to the markets. And then at least that way, then you know you're trading in the right direction, because you're trading in the coattails of institutional order flow or institutional directional bias, rather than trading what you see or trading what you think, should I say. And that's really, really important. Now, as we look at Kiwi dollar, again, similar scenario here in Kiwi dollar. Let me just tidy this up again. This order block liquidity level here, 64.30, 64.75, that we've talked about in previous videos over the last couple of weeks, has mitigated perfectly. Daily order block rejected, wick rejection up as high as 65. Very, very clear move. And of course, if we look on the 4-hour charts, we can see that the price action is now starting to stutter, right? It is starting to stutter up higher highs, higher lows, higher highs. Again, we have seen a little bit of a rally off the Kiwi dollar, off of those lows just underneath kind of 63.40, 63.20. 6,300 really becomes the main benchmark. So I suppose that'll be worth watching this week to see how does the market develop. We have rejected on the daily. We have that very, very clear sell-off, taking out this structure, coming back into this level here. So we're really kind of waiting to see kind of what gets affirmed into the first part of this week, as I said, last really kind of sustainable trading week of the year. Now, if we move across, just kind of one last pair that I kind of want to look at today, and that is, of course, dollar yen. Dollar yen on the FX side, again, very, very corrective, obviously bullish order flow. We talked about it in many videos over the last couple of months, higher highs, higher lows the whole way through. We had that top formation. This daily order block liquidity zone up here at 145 has still been mitigated. However, bearish order flow is still playing out. So we had that very, very deep runoff, lower highs, very, very deep runoff again, coming back into this 4-hour liquidity area. And you'll see over the last couple of days or so how choppy the price action has been. This was Tuesday sell-off. This was the midweek reversal. And of course, price action again rallied back into 138. So from my perspective, I mentioned it last week. I mentioned over the last week or so, you're really kind of looking to see, right, price action has made this deep mitigating bearish impulse. We're really looking to see how does the price action react in this region as it comes back into this zone. And that's really kind of what we're looking at here from an order flow perspective. Because of course, this is the last buying candle before this selling impulse comes out. And now we've got gobbledygook, I suppose, price action up and down, very tricky to read from a higher time frame perspective. So of course, logical scenarios there, wait for the order blocks, wait for the mitigation of structure. And that gives a little bit of a logic, a little bit of a process to follow once you kind of see these considerations. When you can see these things happening in real time, it gives you a little bit more, I suppose, aptitude to your analysis. All right. So that kind of finishes up the FX play. Gold, again, is still chopping at or very, very close to this 1800 level. So we talked about 1800 for the last few days. We did get that bullish daily move obviously failed on Tuesday and Wednesday, and of course price action has come back down. Now, if you're looking at this structure now, I suppose from a 4-hour perspective, we're getting bullish order flow with highs, with lows, with highs, with lows. Price action's making a new high. However, all of this order flow from the last number of weeks from November has all been unmitigated. So there's literally been no sort of mitigation of this impulse. Now, does that mean that the price action is going to rally back into 1650, 1660 down here? Well, that's too early to tell. But what I would be saying is let's focus on the price action in this 1800 to 1810 level this week, because really that's kind of your catalyst, because we tried to break out through it. We tried to create bullish order flow. We're back down again on Wednesday and Thursday. And we're seeing a little bit of a rally into the weekly close. I wonder, is that a case of markets trying to hedge? Is it a case of mitigation of order blocks? And if that is mitigation of order blocks, where this is the last recognized low, which is a little bit tricky considering you've got lows here and obviously lows down here, then you're really looking at the process of, well, if that is to be the case, do we get one last kind of brief flash impulse back into this, as I said, 1800, 1810 level? And that's really kind of the key consideration that I would be looking at this week to see if we do get that one last rally into this region, do we get that clear sell-off? Do we get that validated move? But that kind of gives us a little bit more structure again to the approach to see how we're going to finish the year. And of course, the after action move against what's been a very, very volatile week, as I said, at this 1800, 1810 level. And of course, a couple of weeks of very, very volatile price action. If you look at the weekly closes, the daily closes really isn't much better. So that's kind of what I would be saying there on that one. If we move, I'm not going to look at oil because oil is still obviously quite choppy. So I'm going to give oil another couple of days and then we'll talk about oil during the week. As we look at the indices, broadly speaking, what's happening in the indices? Well, we've got a daily order block here has been mitigated. So if you were looking at S&Ps, firstly, right, you've got your daily order block here at 4065. But again, if you go to a 4-hour chart, multi-time frame analysis, you can also see that there's a 4-hour S&P order block, and you'll notice how the price action is flagged up, rejected it perfectly, tried to break out through it, didn't take out the wick highs of the liquidity, and of course has come back down. Now, initially, this was the up and down movement off of the CPI print. We then consolidated Wednesday, FOMC, dragged it lower. Then, of course, Asia session, we continued to drift lower. And then Thursday, Friday, off the back of the Bank of England and ECB, it only contended for a bearish sentiment because, of course, for the markets, the fundamental events are, I suppose, the catalyst to kind of prompt the markets to make those moves. Whereas, in actual fact, when you look at the liquidity, when you look at the order flow, this movement that occurred on Tuesday is the exact inverse, the exact opposite of the move that took place on the October CPI. So this is the October CPI. If you go to a 4-hour chart, go down across, you'll see it there, manipulation back into range. And then we got that one last liquidity move before the bullish trend came out. And then, of course, on this side, bullish move, taking out liquidity, breaks structure. So now you're really looking to see, well, can we get, like we did here, can we get that kind of one last impulsive move, maybe back into 3980, 4000, and then set the tone for lower highs for the market to ultimately unwind or correct back into this 36, 3700 levels. Now, of course, if you look at it from here, this liquidity area on the daily has been mitigated, and notice how the price action actually bounced off of that into Friday's closure. So that is proving it to be a short-term bottom as well. So I suppose from that perspective, obviously we've broken structure, we've taken highs in liquidity, we've now taken lows. My direct, I suppose, bias would be to wait and see if there's any sort of relief rally, take out the last of this initial liquidity move, and then start to set the tone for selling. Whether that happens or not, let's wait and see. We've got kind of 2 or 3 big days of trading this week just to see how we kind of close into, as I said, the back end of the last week of the year effective. Now, Nasdaq, again, similar scenario. Nasdaq broke structure. So all three have been very, very interesting. Nasdaq takes the highs back into the range, breaks to the downside. So of course, if you're looking at Nasdaq now, you can see it there very, very clearly. We take the highs, then break structure through the 11.5 area per se. You can kind of see it there as well. And of course, what happens then, the price action continues selling off all the way back to this daily order block down here at 11,000. Now we are trading a little bit above that. So at this point in time, it's interesting to see whether the price action comes down here, mitigates this daily order block, and then maybe comes back up to take this. So I suppose that's where you're looking at the both scenario analysis to kind of give you that clear bias. Wall Street, Dow Jones is an interesting one because, of course, daily order block over here. So we've taken out this liquidity from August, then with all of this order flow, the rest of it all the way back up to April. And of course, markets finds the bottom. We rally all the way back up. Order block rejection off of the 34,875 level. And of course, what happens? Well, from that, the markets break structure. So we get that clear, very, very overarching break of structure. This kind of consolidation where the markets was holding up very, very nicely has effectively given way on Thursday as bias now becomes somewhat tilted to the downside. Now, of course, Dow Jones had a massive rally to the upside, taking of liquidity back down again. So if you look at the 4-hour chart, you can even see it there as well. If you exclude this initial impulse, price actions flagging up, 4-hour rejection as well off of the daily order block, gets that one last little push before the FOMC, drags it down, takes out the initial lows, as I said, here around 33,400, and becomes very, very overarching. Now, again, if you look at this now, you're starting to see bearish order flow because you're starting to get the lower lows, lower highs. So now it's just a case of, can we break this short-term impulse, get one last move higher back into this region, and then see, is that the highs then for December? Because this looks very much like to be the highs for December. And then seeing, can we get that correction? Because of course, as we said in previous videos, what goes up must come down eventually, whether it's euro, whether it's FX, indices, gold, oil, it doesn't matter, right? You'll generally get evening out of order flow between the battle between the buyers and sellers, and that's really, really important. Dow Jones, lastly, again on the Dow Jones, this area that we talked about, this 14,550, 14,600, right? This daily 4-hour order block level, rejected, got that brief fake out move. Again, didn't take the highs here at 14,700, rejected around about 16,675. And of course, what happened from there? Markets comes down, takes out this wider structure here at 14,200, and then continues selling off all the way back to just underneath 14,000 or 13,900. Excuse me. So that's really kind of where we are now. We're now trying to take out back underneath this area. So I'm just going to remove that from consideration for the minute. And now it's just a case of, can we get, as we look at the price action now, we've taken out the liquidity, we've stop punted, we've consolidated, we've broken structure. Can we get that one last little impulsive move back up into this region here? And that's, I suppose, the key consideration for the next week or so. And of course, as I said, what goes down must go back up. Will we get that one riding move back in to take all of this bullish order flow out from October? Let's wait and see. So lastly on the list then is the FTSE. Excuse me. And of course, FTSE has taken out liquidity on the November highs. So you'll notice how FTSE is slightly different because the highs actually formed in November, month end, rallied as high as possible, took out, mitigated all of this from August, mitigated this secondary impulse from September, came all the way back up to this level, rejected. Then we had the structure. Now, if we look at the 4-hour structure, we've got initial taps, we break down, we get that last impulsive move, excuse me, all the way back up to this 75-65 level, rejects utility, comes back down and breaks through this secondary structure here. And now, of course, as we said, with bullish order flow the whole way up, you can kind of see the different levels, the higher highs, higher lows, the structure, just to break down the trend. And of course, what happens from there? Well, the markets has completely undone that because we're now breaking back down. So now it just becomes a case of waiting to see how deep or how high these retracements come into to then allow for the next phase lower. We talked about it last week. Would it be inconceivable for the price action to close the week at 72, close the year at 72.50, 7,300? Well, initially in 3 or 4 days, we've gone from way up comfortably here at 75s in a matter of days to drifting lower to 74.50. And then once we broke through 74.50, that's the initial catalyst. So it looks like very likely the price action is going to try and work its way back down. And if you even look left, you've got levels here, you've got 7,200. I think that wouldn't be an unlikely scenario. I think that becomes a probable more realistic position. And then it just becomes a case of evening out the risk apportioned to that as well. All right. So that's where we are for the minute, folks. So of course, we'll do a couple more videos during the week just to kind of round off the year, just for housekeeping. But of course, trade safe, have a great weekend, and take care.